By replacing off-balance sheet loans with bonds, China seeks to save $600 billion in interest over 5 years, buying critical time to address systemic financial pressures. Additional measures include encouraging state-owned entities to purchase unsold apartments, reclaiming undeveloped land, and increasing capital for state-owned banks. However, these policies lack detailed timelines, leaving investors speculating about their full impact. China's economy is currently facing serious challenges. Q3 2023 GDP growth was 4.6% year-on-year, falling short of the 5% target and raising concerns among analysts. While a stronger economic stimulus is expected, the debt swap marks a shift from comprehensive cash injections to more targeted financial restructuring. The International Monetary Fund (IMF) estimates that China's hidden debt could reach $8.6 trillion, or 47.6% of GDP, by the end of 2023, far higher than Beijing's official figure of 14.3 trillion yuan. Economists argue that China needs stronger consumer stimulus measures to counteract high youth unemployment, low wages, and an underdeveloped social safety net. With household spending accounting for less than 40% of GDP, 20 percentage points below the global average, many experts believe more aggressive action is needed. China's cautious approach to consumer stimulus may reflect geopolitical considerations, including uncertainties surrounding U.S.-China trade relations. Following Donald Trump's re-election and his renewed threat to impose tariffs of up to 60% on Chinese goods, Beijing appears to be reserving its economic ammunition for potential trade conflicts. Analysts predict China will adopt phased stimulus measures, adjusting its strategy based on global developments. The debt package highlights China's attempt to stabilize its economy and manage financial risks. However, it avoids direct measures to stimulate domestic demand, which some argue is essential for long-term recovery. Economist Tan Heng from the Peterson Institute for International Economics describes the package as a necessary but insufficient step, emphasizing that deflation remains China's biggest challenge. Heng also noted that Beijing opposes cash handouts, which it views as contradictory to its anti-welfare philosophy and a potential source of dependency. Investors are now closely watching the December Politburo meeting and the Central Economic Work Conference for more clarity on China's fiscal strategy. These meetings will also provide insights into how China plans to address challenges like U.S. tariffs, sluggish consumer spending, and geopolitical tensions. China's economic challenges are compounded by uncertainty over U.S. trade policies. During Trump's first term, the U.S. imposed tariffs on $360 billion worth of Chinese imports, triggering a prolonged trade war. Renewed tariffs could disrupt China's efforts to stabilize its economy, even as its exports remain a bright spot. However, analysts believe Beijing's debt package reflects its intent to prioritize financial stability over aggressive short-term growth strategies. China's $1.4 trillion stimulus package represents a bold effort to restructure its economy, mitigate financial risks, and stabilize local government finances. While it may not deliver immediate economic growth, the plan positions China to navigate complex domestic and global challenges with a focus on long-term stability. The outcome of this initiative will have profound implications for China's economic trajectory and its role in the global economy. Critics highlight the limitations of China's debt package, particularly its focus on supply-side measures rather than stimulating domestic demand. This approach could exacerbate industrial overcapacity, especially if an export shock occurs, leaving manufacturers struggling to clear inventory. Without a recovery in domestic consumption, higher tariffs could reduce revenues, profits, and private investment. Economists argue for direct income support to households to boost spending and consumer confidence. Debt swaps, while helpful, failed to resolve the core issue of local fiscal revenue shortfalls. Local governments will still need to borrow more to fund basic operations. Victor Shi, an expert on Chinese politics and finance at the University of California, San Diego, warned that the current small bailout packages offer only temporary relief, failing to address the growing underlying debt. These measures, significantly smaller than expected, fall short compared to the 2008 stimulus package, which exceeded 10% of GDP. Carlos Casanova, senior Asia economist at Union Bancaire Privée, estimates that China needs approximately 23 trillion yuan to address real estate inventory and hidden debts. He noted that the current measures remain heavily focused on infrastructure and real estate, rather than direct consumer support, which has proven effective in U.S. stimulus strategies. Casanova added that Beijing appears to be delaying more decisive stimulus measures to assess the actions of Trump's administration. According to UBS, a 30% tariff on Chinese goods could reduce China's GDP by 0.3 to 0.4 percentage points over the next 2 years. This underscores the urgency for Beijing to manage market expectations and reduce systemic risks in the banking sector while addressing local government debt. The real estate sector remains a focal point, with deflationary pressures significantly impacting the economy. Measures like the 10 trillion yuan refinancing package for local governments surprised many analysts, but these steps are still considered insufficient to revive the economy or stimulate consumer demand. Analysts believe Beijing may hold back heavier stimulus until the geopolitical landscape stabilizes, especially with the renewed threat of tariffs under Trump's second term. Trump's return to office marks a new phase of confrontation between the U.S. and China. During his first term, Trump implemented punitive tariffs and trade restrictions to curb China's economic and technological rise. Experts predict that his second term will bring continued protectionist policies, posing further challenges for Beijing. Trump's "Hire American, Buy American, Build American" campaign remains central to shaping U.S.-China relations. China's exports face significant threats from Trump's tariff policies, including his pledge to impose tariffs of over 60% on goods imported from China. Such a move could severely impact the world's second-largest economy, which is already grappling with high youth unemployment, a prolonged real estate downturn, and a growing public debt burden. UBS estimates that a 60% tariff could cut 2.5 percentage points from China's projected economic growth, or about half of its annual growth rate. China's export-dependent economy has prompted factories to accelerate shipments to mitigate potential tariff impacts. In October 2024, China's exports grew by 12.7% year-on-year, the fastest pace in over 2 years. This surge was driven by factories rushing to deliver goods to major markets like the US and EU before the two-front trade war materializes. Exports to the US increased by a staggering 88.1%, while shipments to Europe rose by 12.7%. Despite trade restrictions, China has made significant progress in technology, accelerating efforts in self-reliance and R&D investment. During Trump's first term, restrictions on high-tech exports to China, such as advanced semiconductors, compelled Beijing to prioritize domestic innovation. These efforts have narrowed the technological gap in critical sectors like AI and space technology, although China still lags in areas like advanced semiconductor manufacturing. A notable breakthrough came with Huawei's Mate 60 smartphone series. Research revealed that its domestically produced chips are far more advanced than expected, suggesting that China is only 4 to 5 years behind the US, rather than the previously estimated 8 to 10 years. This leap highlights China's strategic focus on advancing critical industries under President Xi Jinping. China has implemented robust measures to support priority sectors, including low-interest financing from state banks, state-owned enterprise collaboration, and substantial investments in tech companies like Shanghai Microelectronics Equipment. While China has not yet matched ASML's advanced lithography capabilities, billions of dollars have been invested to close the gap. Huawei's Mate 60 further underscores this progress. A teardown revealed its chip capabilities exceeded expectations, narrowing the technological gap with the US and raising concerns in Washington about its potential military applications. Meanwhile, China's share of the global high-tech market continues to rise, particularly in electric vehicles, EVs, where domestic manufacturers like BYD lead the industry. China's $1.4 trillion stimulus package represents a calculated response to mounting economic challenges and geopolitical pressures. While it prioritizes financial stability and risk reduction, critics argue it lacks the scale and focus to address core issues like consumer demand and local government revenue shortfalls. At the same time, Trump's return to office and renewed tariff threats add uncertainty, potentially complicating Beijing's path forward. China's advancements in technology and rising export volumes signal resilience, but the effectiveness of its strategies will depend on managing domestic and global challenges. As Beijing balances short-term stability with long-term growth, the coming years will test its ability to navigate an increasingly complex economic and geopolitical landscape. Despite U.S. tariffs and restrictions on technology access, Winston Ma, a former executive at China's sovereign wealth fund CNIC, highlighted that the impetus for China's technological self-reliance originated with the Trump administration's 2018 ban on component sales to ZTE. This move accelerated China's push to replace foreign technology with domestic solutions. Following this, President Xi Jinping called for strengthened self-reliance in science and technology, leading to a surge in domestic projects, from just 4 in 2015 to 169 in 2023. However, Chinese chipmakers continue to face major challenges, including export restrictions and limited access to advanced chip technologies. Both Ma and Nazak Nikokter, a former U.S. Commerce Department official, predict that future U.S. administrations will tighten export controls further, expanding restrictions on Chinese entities. This could place significant pressure on China's tech ecosystem. Ma emphasized that the next 5 years will be pivotal for U.S.-China technological competition. Meanwhile, Donald Trump, with a potential re-election bid, has maintained a hardline stance on China, criticizing Biden's Chips and Science Act and accusing Taiwan of stealing the U.S. chip industry. These policies not only impact the global semiconductor supply chain but also raise concerns about security risks tied to Chinese EVs, which could collect data on U.S. consumers. In a potential second term, Trump may impose higher tariffs on imported Chinese electric vehicles, EVs, to protect domestic automakers. Data from freight analysis firms indicate a surge in container traffic from China to Mexico as Chinese companies shift production there. Jordan Dart, president of logistics company Redwood Mexico, noted that container flows increased significantly, with April to June recording the highest export volumes from Mexico to the U.S. This trend is facilitated by the United States-Mexico-Canada Agreement, USMCA, which replaced NAFTA in 2020 and eliminated most tariffs among the three countries. In 2023, China invested $3.7 billion directly in Mexico, a sharp increase from previous years. A notable example is the Husan Industrial Park, located 25 kilometers north of Monterrey, Mexico, now home to at least 30 Chinese companies, including 9 automakers like BYD and Chery. These firms have transitioned from importing finished goods to producing raw materials and components locally, then re-exporting them.